If you haven't heard of real estate tokenization before, I'm going to be taking you on a deep dive of what that is, how it works, the pitfalls to avoid, and in my opinion, how much of a rug pull it's going to be for investors who don't really know much about investing in real estate and also investing in very complex products like this. So I've been a tax advisor for the last 15 plus years now, helping advise real estate investors, business owners in the $5 million to $100 million of revenue range. And I help them with growth, profitability, risk, and most importantly, avoiding taxable liability. So this concept of real estate tokenization, it's effectively having a group of investors digitally own, and I'm going to put own in quotes, a piece of a real estate asset. And now what that does is imagine you form an LLC to purchase a regular single family home, and let's say the price is $500K. So a person would purchase this $500K home, and then they would offer it as a tokenized real estate. And to keep the matter simple, it's basically like saying, I have this real estate. I have 100 coins that represent the value of this real estate. Now I need 100 people to purchase each coin, each of them worth $5,000. So 5,000 times 100 and you get 500K. And that's just for the value. And now if you hold your coins, you also get to enjoy the cash flow after that rental property or after that property is being rented out or however it makes money. So this might seem like an ideal concept because it sounds great. You just have to invest, $5K and you get access or you get profitability from a $500K property that's being rented or a 1/100. Now, if we lived in a perfect world, this would be, super great. You would, every time you have 5K, you would invest in a new asset and you would have a 1/100th return or whatever the number is. Now, the process works like this. You have a investment firm that buys this deal as they would buy this deal regularly, right? So they group their investors and maybe they have a few, tens to hundreds of investors on a larger building. And then once they purchase that, then they offer it, they create a sale to a tokenized market. And now the first gotcha in this transaction is now that the initial investors who put up the cash or the investment firm who put up the funds or liquidity or loans to purchase this property, they now sell it to this tokenized LLC. And I'm going to be guessing here, but it's usually going to be for a profit, even if it's been held for only maybe a few months. So that's the first gotcha. So they sell back the company, the investment firm sells the asset to the related LLC, which will now tokenize the value of the asset. So that's the first gotcha. You are buying a tokenized property that's already has its price inflated. So now you are buying something that's overinflated, essentially. Now, the next area is now you need somebody to manage that property. And obviously, the investment firm who has tokenized this real estate is also going to be managing the property. And that management fee comes out of the cash flow of the building. So in the perspective of the investment firm and management company, they're up so far. They're doing great. They just sold the building for a profit, made investors money. Wonderful. And now the investment firm or subsidiary of the investment firm, possibly the management company that is managing the tenants and the maintenance and facilities are now earning a 2 to 3% investment fee on that very large property. And that's great for them. Now they get paid and they're all doing good. And now there are more fees. There are vendor fees. There are asset management fees. There are construction oversight fees, especially if there has to be renovations done. There are refinancing fees. There are carrying fees, interest fees, promotion fees, advertising fees, etc. So it goes down the line of now this management company or subsidiaries, they effectively can charge whatever they need to charge that can be justified into charging this asset fees. And where do those fees come from? Those fees come from the cash flow of what the tenants are paying rent for. So now in a normal deal where the investment fund would be the sole owner, they would try to keep fees to a minimum to show either more profit or move profit into different subsidiaries. But at the end of the day, they would keep this cash flow. What's happening now is the investment fund or the subsidiaries, they don't really care about the cash flow and being profitable because they're extracting all the profit. And if there is remaining profit, which potentially there is not because already real estate has very slim margins, all those slim margins or losses get passed on to the owners of the tokenized real estate. So that's just one item on the list that I'm going to share with you. The next is the construction companies, the renovations that have to happen. Because if you're looking at a large building, typically there's always being something worked on. There's always construction. There's always maintenance. There's always something being worked on. And now if the investment fund has subsidiaries or receive kickbacks, then they'll make a profit, essentially maybe 20 to 50% on top of the actual construction costs. They'll make a profit on top of that and extract even more profitability from that asset. And the next item that is really going to cost investors a lot is the whole refinancing game. Since these management companies or investment funds make the operating agreement vastly more effective on their end than the shareholders or the token holders end. And obviously I don't mean to come across that anything of this is illegal. All of this is being stated plainly in the terms and conditions of the contracts that everyone will have to sign for before they invest. And even though it's stated that they're basically going to take everything, all the liquidity from this deal and keep you holding just some kind of phantom asset, it still doesn't make it right. And I'm a bit biased when it comes to this, is because they're just looking to get a profit from their building, which they have. As soon as they tokenize a building, they've already made their profit. Then the next is to really kind of dig the knife in you. Then they charge these ridiculous fees on cash flow. So the token holders are going to be investing in the building, which they've already made a profit on. Then they're also going to be paying these inflated rates for construction or management fees, or etc. And then the final stab in the heart is going to be basically refinancing the property, where it's so over-levered that now they've extracted even the equity in the building. And now they've taken that money. And now who has to pay it back? You have to use the tenant funds to pay back the liquidity. And because I suspect that larger investment funds will have voting rights to a minimum given to token holders, and voting rights to the management company being like majority voting rights, there's going to be very little say for the token holders, even if they think they should change management philosophy or processes or procedures. There's going to be very little that the token holders can do or can request, because the management company basically owns all the voting rights, and they basically only supply a limited amount of information. So you won't even be able to see what's going on in the background. So you'll just think, oh, it's expensive to build in New York or California or Texas or Florida. You won't understand that, oh, no, it's the price is inflated by 50% because they're making that extra 50% on the construction cost. It's like, oh, so that's, and then the biggest issue, what I mentioned, is refinancing, is now they're extracting all the equity of that asset, or a very, very high percentage of equity of that asset. And that's mainly to put it into a next deal. So the management company or the investment fund will extract that equity, put a huge loan on it, and then they will put that loan into the next deal and fund the next deal, and then sell that next deal to more token holders and repeat the process again. And why that is a bad deal is because, as everyone knows, if you take too much debt out on a property and it can't afford to pay the debts, then that will eventually go bankrupt, or you'll have to sell at a loss. And then what happens to the token holders? The value of their token goes down because it's attached to that asset. So if that asset sells for a loss, guess what? That 5K that you invested for one out of the 100 tokens, now that goes down to maybe $2,000. So not only have you invested your 5K and you've received very minimal or no cash flow from this deal, but now at the end of the day, maybe market speculation will go up and down as it does. It's not exactly correlated to the asset, but as the price goes up, because maybe this is going to be a new concept in a few years, and people get excited for, oh, I own 1/100th of this building. So exciting. Now I'm willing to buy it for $10,000 or $15,000. The people who will make money are the early investors or the early accredited investors with these tokens. And then when they sell, they'll be clean. They're not looking at it long term. They'll sell it to people who are looking at it long term and saying, oh, I paid a little bit high, but I'm willing to hold it because I know in the end I'm going to get a good return on it. Just thinking that the real estate always goes up, I'm going to get a return, etc. And not understanding that now you just bought it at the height from the initial investor who got in at a very good price. And it's most likely not going to go up because it's heavily mismanaged. And again, this is dependent on the investment firm running it, but I suspect that probably 90% of investment funds of tokenized real estate will be taking advantage of their tokenized investors. So it mainly comes down to at the end of the day, if they mismanage the property, the value will be vastly lower than what you initially bought it at. So if you're one of those lucky few who had the initial token, sold it, the token holder in the middle will most likely lose because tokenization is such a new concept. There are going to be a bunch of fraudsters, scammers, etc. in that space promising you the world. Meanwhile, they're taking advantage of the cash flow. They've already made their profits, and now they're going to refinance on top of that building and put the building in a bankruptcy, almost a bankruptcy situation, and just reduce the value of that asset and be just due to this mismanagement of cash flow and management fees and all related fees. And this is still just the basic things that can go wrong with the tokenized real estate. On top of that, they can also dilute the tokenization that you have, the tokens that you have. So instead of selling all 100 tokens for $5,000, now they might hold back, 5 or 10% of this, maybe more, and then dilute that and break that into further fractions and sell those further fractions to even more people. So thereby reducing the value of your one token. And then, as I mentioned, if the management company or investment fund were to refinance on this property and values in America dip under the debt position, under the debt value, then it could be forced into a sale. And then this forced sale, guess who's going to buy it up? Another subsidiary of the investment fund. And what are they going to do? They're going to buy it for, probably 20 to 50% below market. They're basically going to clean up the debt, or they've already, bankrupted on the debt. They're going to clean it up, make sure it's cash flowing again, make sure they reduce their management fees, everything. So it looks again like a great value building. And then what happens next is they take that building and then they tokenize it again to new investors who buy a 1/100th coin of the real estate, and they start the cycle all over again. So if you're an investment firm and you're tokenizing real estate, you're going to be making lots of money, a lot of money, like hand over fist, probably 200-300% of the building's value. And it's great for you. But for the normal investor, they're going to lose their investment, albeit it's probably not going to be a large investment per investor who is buying this tokenized real estate. But that's who they're targeting. They're now targeting people who are not investor savvy. They don't understand the terms and conditions of the deal that they're participating in because they're treating it more like gambling. The average person, they have their 5,000. They're like, oh, a real estate, I can purchase a fraction of real estate, and real estate always goes up and it makes cash flow. What's there not to love? So they'll put their money in, and then essentially they'll sell it for lower than it's worth in a few years, because obviously there's so many ways that an investment fund can take advantage of that asset and make it worth less while extracting all the resources. So my recommendations is this: you need a financial advisor, a tax advisor. You need a somebody who knows these concepts, and you need that advisor before you waste a few $1,000s of your investment. So this is nothing, this concept is nothing new. It's the same as it's always been, and it's just another wrapping on a product. So you might think it's like, oh, it's something new, it's something they can't break because it's backed by blockchain. All blockchain is just transparent ownership. It's not going to tell you, the blockchain or Bitcoin or however you purchase these tokens, it's not going to tell you if it's a good deal or not. Because if the investment fund puts everything in the terms and conditions, exactly how much they're going to, charge you, and all the different things that they have control of that you do not have control of, and how much voting power they have versus how much voting power you have, you really can't do anything to get your money back or to complain about, because you agree to the terms and conditions. Whether or not you read it, that's really on you. And that's what these investment funds are banking on. They're banking on investors who don't have the knowledge to read through the terms, to understand the terms, and they're banking on just people gambling with their money. And if you can do that to enough people, then these investment firms are going to be uber profitable, because number one, they're selling their real estate to a tokenized fund already for a profit. Then they're extracting more profit from the management fees, construction fees. I won't call it a kickback, because a kickback is illegal in most states or the country. But this is basically earning a percentage on top of the cost of all these different services. And then on top of that, they can then play with the equity of the asset. Even though the token holders own the equity, they most likely don't have a say in the debt that's covering that asset. So the investment fund or the management fund can extract all the debt possible, or take on debt on that asset as much as possible. And the investors, unfortunately, get left holding the bag. But you probably won't have very savvy investors, and they won't understand, why the value is going down of that building, even though they think that every year should go up, right? And that's where it's important to understand the terms and conditions and understand the track record of the investment fund you're working with, or the parent company or related parties of that investment fund. Because obviously there can be, investment fund 1, 2, 3, 4, ABCD, it could be the name, but you have to see who the owners are, who the parent companies are, how the original deal originated, and understand what the track record of those parent companies are. So if they have allegations of doing this same exact thing with a different product, you need to take it seriously, and you need to avoid companies like that. Because, although it might not seem a lot for most people, like $5,000, $10,000, but when you invest that money, you want a return on that money. And at a certain point, even if you get in early, those people who get in early and then sell as the price goes up, they'll make out okay because they understand the game. But typically the secondary market who's purchasing these tokens, they don't understand the game. They think value always, the real estate always goes up, and they're never going to have an issue. But the reality is, the secondary market is going to be taken advantage of, like in every other coin or anything else that's been introduced, any new product, they get rug pulled. So if you're watching this video, I hope you can take this information with a grain of salt and just do a little bit more research before investing 5 or 10K, because I know for some people in the US, that's basically all their savings, and I'd like to help just the average investor, or even if you have a lot of funds to play with, you still don't want to lose 100 to 500K just on like a gamble. You definitely want to do your due diligence. Then I try to help my clients the same way. If a new product or a new something opens up, I like to read through the finer details and understand the track record of who they're buying from. That's most important, because if the investment fund or the person offering the investment has a track record of, screwing over the investors with high management fees, a lot of debt leverage, etc., it's probably not going to turn out well. And you don't want to gamble timing, as in, buy now and then hopefully you can sell to a sucker, down the line. But you want to go with a reputable company that is honest about their fees, and it's more towards market rate and not some inflated value that you'll never see come back to you, as a tokenized investor. So hopefully you find value from this, and I hope you all good luck. If you come across any tokenized real estate, please just do your research. Don't just gamble with your money, but you have to be confident that you will get an ROI based on the track record of the investor and the terms and conditions that you're signing up for. So that's very important. You got to do your due diligence as well. And, in real estate or in business or investments, there is potential risk. Anything can happen, but you want to mitigate those risks and reduce them as much as you can for the information you have available. Thanks for watching. Please like, comment, and subscribe. I appreciate it. Thanks.